In this video, guys, we're going to look at a call option contract example. Hey traders, warm welcome to you. Okay, so let's run through an example of a call option contract. Let's look at it in the broad sense, then let's look at an actual worked example with real numbers so we can see exactly what happens in a multitude of different scenarios. Right, let's go. So first of all, let's just recap on what we've got. We have a stock here, and let's say ABC stock again, and it's currently trading at 175 bucks, right? That's the current price now. We would like to buy a $200 call option for 3-month expiry. What does that mean? That basically will give us the right, but not the obligation. Remember, as a buyer of options, we have the right, but we don't have the obligation. The seller just has the obligation. If the right is exercised, they have to do what the buyer wants. To purchase stock at $200, 3 months in the future. If we're currently trading at 175, then at the moment, that option has a value. What determines the value of that option? Time to expiry. How long is it? 3 months? Not so long. 3 years longer. If it's a 3-year option, it's going to be more expensive because the stock could do an awful lot in 3 years compared to 3 months. Price versus strike. How far away is the strike price? 25 bucks? Not too far away. Let's say that was 2,000 bucks. Chance of doing that in 3 months, pretty slim, right? So that means the option price is going to be way, way, way cheaper. It's going to be it's going to be very, very unlikely to happen. So the price of assuming that risk, the price the seller asks, is going to be almost nothing. You think about if you went into a bookmaker's, right? And you said, okay, what are the chances of it raining in Britain on a October morning, example? It's going to be pretty high, right? It's going to be quite expensive to take that. But what about if it said, okay, what are the odds of Elvis Presley crash landing a UFO on the head of a Loch Ness monster? That's probably not going to happen. So we're going to give you really, really high odds, and it's going to be very, very cheap if you're talking about an option. So there's stupid analogies, but you get the point. So the price versus strike. Then we've got the volatility. If a stock is more volatile, then the price of the option is going to be higher, right? If this thing is swinging around, 10 bucks a day, the chance of it getting to 200 bucks in 3 months is pretty high. So for a seller to assume that risk, they're going to want a big premium on the price of the option. It's not going to be cheap. Whereas if this thing's swinging around in 10 cents a day, the chance of it getting there, even if it carries on as it is, it's not going to be very likely. So they're going to say, okay, I'll assume that risk for not a lot of money, and the premium will be very, very small. So you can see how these major components will adjust the price of the option. The volatility of the underlying asset, the price versus the strike, how far away it is, and the time to expiry, again, how long it's going to take. So you can now kind of see, if we adjust these dials, how these will affect the price of this. Right, now we're going to put up another example on a board, and we'll run through a whole example with actual numbers and see what would happen for different scenarios. Okay, so let's do an example with some numbers. Right, we have ABC stock again, and we are currently sitting at a price of $67, right? And we are bullish on the stock. We don't want to buy the stock, we want to buy a call option. Let's look at an example with some scenarios about what might happen. So the July 70 call is trading at $3.15. So we think that July is a good expiry, and we think this thing's going to close above $70 in July. We're quite bullish on it. Don't forget, the price of that is going to be based on the time to expiry. So whether we are 3 weeks ahead, 3 months ahead, whatever it is, going to be how far away it is and the volatility of the asset that we're trading. But anyway, forget about that for now. The price is just $3.15, and we decide to purchase one options contract. One options contract gives us the right, but not the one options call contract gives us the right, but not the obligation to purchase 100 shares of stock at that price, at the strike price. So one contract is 100 shares. That's just something to remember. So this is costing us $3.15 times 100, 315 bucks. Okay, one contract is costing us 315 bucks. So we buy that one contract. The seller or the writer gives us that options contract, takes our $315 and says, okay, let's see what happens. Off we go. 3 weeks later, the stock rallies to $78. So it rallies well over our $70 strike price, and we've still got some decent time to expiry. All of a sudden, the price of that call, the July 70 call, becomes $8.25 because there's a premium automatically of $8 of value, the intrinsic value, plus there's a little bit extra in it because there's not time to expiry, not at the expiry date yet. So just for that example, you could decide to close that option if you wanted to, and if you sold back your call option or your one call option, you'd get $8.25 for it, minus the $3.15 cost to buy the option, times by the 100, you've made yourself $510 profit. So this is quite a decent return on your investment, right? Don't forget though, this could expire worthless. So even though that looks quite good, you're actually risking the whole lot. And let's look at that example now. You decide to hold on, you think, you know what, I'm gonna ride it till the close, I think this is pretty good. I would ride it to the expiry date, I think this is pretty good. So the expiry, ABC, comes all the way down and is trading at $68. You were thinking it's gonna trade above $70. So at July, the value of that July call is zero. Why is it zero? Because you've got the right, but not the obligation to purchase stock at $70 and the actual underlying asset is worth $68. Has that got any value to it? No. So your option has expired worthless. It's cost you $315. You're out of the money. You've lost that money. The seller of that option has taken that $315, stuck it in his pocket. So thank you very much. Come again. The next one example would be this. Okay, we actually rally now. I'll put this on the chart. We carry on rallying, and at the expiry, if I can draw number 8 properly for you guys, let's draw it again. $80. The time, or the price at expiry is $80. Great, we've made some money. Let's see how much we've made. So we've now got the right, but not the obligation, to purchase 100 shares of stock at $70. Are we going to take it? Of course we are, because why wouldn't we? Got $10 discount on the stock. So that's great. So the value of that option is $10, right? There's no extra value in it now because it's at expiry. There's no kind of value in terms of premium for time because there's no time left. We're at the strikes, we're actually at the strike price. There's nothing else apart from the sheer intrinsic value of that option. And that is going to be $80 minus the $70 strike price, $10, right? So the price of that option at expiry is $10, minus the $3.15 that we had to pay for it in the beginning, don't forget, times 100 shares, one option contract is 100 shares, we've made $685 in profit. Very good, great, all works very well. So those are just some examples. And let's just quickly think in terms of what would happen if we bought the stock. And obviously, you bought the stock at 70 then went to 80, we'd make our full $10, but we've got the unlimited risk of the stock basically going to zero. Whereas in the call option example, yes, we've paid a premium, we've made less, but we can't lose more than our 315. This thing could go to zero and we still lost 315. It could go all the way down to 50 and we still lost 315. It could stay where it is. Let's look at that example as well. Actually, if it stays at 70, let's say it expires at 70, what happens to our 70 call? We've got the right to buy the stock at 70. How much is that worth? Nothing, because we can buy it in the underlying market. So our underlying contract, our contract, is worthless because we've got the right to buy at 70. It's currently trading at 70 anyway, so it's still worthless. So you can probably see now, for us to make any money, the stock has got to be at $73.15 or above for us to make any money. Because if anything less than that, we haven't got any value in it because we already paid $3.15 for the option. So there's a little bit of extra juice required, but that's the payoff we have for capping our risk. Anyway, more videos to come, guys. We're going to look at different strategies and different ways of trading options, speculation, using them as insurance. So subscribe, hit the subscribe button and stick around. See you next one. Bye-bye.